Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7:15 Mountain Time on Monday morning, April 7th. For those of you who didn't see our note over the weekend, it was titled The Trump Trade Shock. And the primary message of this week's note was we think that the risks of recession are adequately priced. They've been discounted in the stock market, they've been discounted in the vol markets, and they've been discounted in the fixed income markets. And we think it's time to take a stand and put some money to work. We initially wrote Cleaning Up the Industrial Policy Mess 6 weeks ago. We reached our target on 10-year notes in a week. We reached our target in the S&P 5 downside target in the S&P 500 in 3 weeks. We've obviously blown well through those levels. If you consider where S&P's opened last night, they were down about 22.5% peak to trough. The median decline for a recession going back through to World War II is about 24%. So that's pretty much 100% probability of a recession from that simplified outlook. You know, if you look at the 3-month bill, 2-year curve, that's discounting a recession as well. And importantly, in the vol markets, because as we often say, it's what they pay, not what they say. So we care more about the vol markets than survey measures. The VIX, VVIX, the term structure of all those things are at extreme levels that would suggest that positioning is now quite defensive. We strongly suspect there's been all sorts of liquidation of the multi-strat hedge fund related equity exposure. I'm sure there's been retail selling. We've heard from contacts who manage money for individual investors that there's been lots of frantic calls and selling and the like. And listen, what happened was obviously larger than anyone expected. The first section of the note goes through trades, what we're calling trade surplus penalties. You can't call them reciprocal tariffs. We explained the methodology. We didn't get into any kind of either a defense or a indictment of the methodology. We don't agree with it. But if it actually does bring some of these other countries to the table and the negotiations do result in offsetting those trade surplus penalties, and we would assume that that will happen in the cases of Europe and a number of the smaller Asian countries. The negotiations with China are going to be far more complex. Perhaps the methodology will be forgotten about over time. But we also assume that we're going to have a basic baseline 10% tariff through the rest of President Trump's term. So we're not going back to where we were. And we always thought that we were going to wind up with higher tariffs like everyone else. We just didn't think the order of magnitude of this was going to be as large as it is. We then went through a little bit of the history of trade policy. Again, we're recommending Doug Irwin's great book, Clashing Over Commerce. We think this is most like the shock that took place in 1971 when Nixon eliminated gold convertibility, instituted wage and price controls, and a global 10% tariff. That's probably the best analog for the situation. And that did lead to a global reordering of, the financial and trade systems. And it actually did slow the growth of our trade deficit for a time. We then went through policy priorities, and this is a key issue for us. From our perspective as an investor, the number one policy priority is stabilizing our debt. And the only way to do that is to cut spending back to 20.5% of GDP. That's our number one policy. Number two is getting to some supply side corporate tax incentives, trying to restore the incentive on equipment investment, R&D, adding to that some additional incentives around building physical plant. This is more carrot than stick to try and rebuild our manufacturing base for a myriad of reasons, including national security aims. Number three is deregulating the energy and financial sectors. Immigration and trade are distant fourth and fifth from our perspective as an investor. Those are the things that got President Trump elected, though, and they are at the top of his list. This brings us into the policy sequencing we were always concerned about. And the reason we've been urging caution, even though we hit our targets in fairly short order, is because we were always going to have to get through these issues, trade in particular, before we could move on to more of the carrot type issues that will spur investment. The question is, has the policy outlook bottomed out? We used a quote from Clark Griswold when all hell was breaking loose in his house when the squirrel got loose. And, take a look around, Ellen. We're on the threshold of hell. We're not trying to be flippant about all this. We're losing money just like the rest of you. But we do think that there is a good chance that the policy outlook is going to bottom out and get better from this point forward. Deals will get negotiated. We will move forward onto tax policy. Hopefully, the House will win in the battle with the Senate about how much we're going to cut spending, and that this won't derail the policy agenda. Congress won't get weak knees about cutting spending because, again, that is the absolute necessary condition to get this country on the right track, is to stabilize our debt and deficit. We then went on to discuss the monetary policy response. We're, for lack of a better term, just dismayed by the Fed's reaction to all this. The markets are screaming disinflation, recession, and the Fed is standing there like Chip in Animal House going, remain calm, all is well. We're worried about inflation. It's nonsensical. Look at the markets. This is not an inflation problem. This is a disinflation or even deflationary growth related issue. So just to try and wrap all this up, the S&P and rates markets have, in our view, pretty fully priced a recession. Importantly, not something we put in the note, but we think you all know, the best returns are early in the business cycle. So if we are headed for a recession, the timing may be a little bit early for the market to bottom, but you do not want to miss that ferocious rally that we get out of every business cycle that we've had going back to World War II. So we do think it's time to make a stand. We suggested taking money out of intermediate fixed income and putting it into financials and energy here. Those sectors were holding up quite well until the end of last week. Saw a Morgan Stanley downgrade of large banks this morning. We thought that was a crazy time why you would do that right now. But to be sure, we're going to have to get through earnings season. We've been urging caution around the equity market fundamentals for some time because net revisions have been falling. The question is, can they bottom out during this earnings season? We get expectations marked down sufficiently that the rate of change of earnings estimates will start to bottom out and start moving back up. Key issue, we will, because of this CECL accounting standards, we'll see some significant reserving from the banking system for the probability of a recession, which obviously has gone up a lot. So it will be a very tricky earnings season getting started this Friday. But again, we do think it's time to make a stand and start putting some money to work. So that's it for me. Barry Knapp from Ironsides. Have a good week, everyone. We'll be in touch. Feel free to reach out. Thank you.